Most people think a software company wins by selling more software, but the real game is stranger. A company can add thousands of paying users and still march toward collapse, while another grows slower and quietly becomes inevitable. The difference hides in math that never appears in a launch video, yet decides the ending long before anyone rings a bell. Imagine two curves on a dashboard. One climbs with new revenue. The other shows how much the existing base is shrinking or expanding each month. If the second line does not overpower the first, growth is a mirage. Here is the bold truth that sets the table. In recurring software, a dollar that stays is worth many times a dollar that arrives only once. And when dollars from the same customers expand over time, the compounding overwhelms almost any acquisition tactic. Hold that thought, because in a moment, we will name the single metric that quietly predicts survival more reliably than press or downloads ever will. The early aha is simple. Software is not sold one time. Software is a behavior that either hardens into habit or erodes into churn. The invoice is a receipt for a habit. That is why the surface story of logos and headlines feels so misleading. The real story lives in cohorts that return every month and either pay the same, pay more, or disappear. Picture a retention chart where the first month drops a little, then flattens, then rises as teams add seats and features. That gentle rise can fund an entire sales machine without a single new lead. Growth becomes a property of the customer you already have. SaaS companies do not just sell software. They sell friction against leaving. Here is the first micro shift that changes how you read any quarterly update. Acquisition cost looks scary up front in software because cash goes out today, while revenue comes back in small bites over many months. That delay makes a healthy business look broken until the cohorts mature. When the average customer returns long enough and pays more over time, the lifetime value overwhelms the initial cost. The payback period shortens, marketing turns from expense into engine, and the business flips from burning to compounding without changing the product at all. Revenue growth means nothing in software if the product leaks customers out the bottom. Now, make the picture sharper. Two companies show the same top-line growth. One spends aggressively to acquire customers who stay 12 months and then drift away. The other lands smaller accounts that expand steadily for 3 years. On paper, they look similar this quarter. In reality, they live in different universes. The second company has discovered that expansion is the quiet twin of retention. Expansion is not a coupon or a sale. It is the natural outcome of a product that spreads through a workflow, earns new seats, unlocks modules, and justifies higher tiers without a new pitch. Over the next decade, the winners will be the ones with the highest expansion-adjusted retention, not the flashiest acquisition stunts. Here is the next turn of the lens. Price design is not about numbers on a page. Price design is an agreement about how value shows up in a customer's day. When the meter lines up with the moment value is felt, renewal becomes obvious, and expansion feels fair. Seats reward collaboration. Usage rewards scale. Modules reward sophistication. The wrong meter punishes the customer for exploring the product. The right meter lets the customer grow without anxiety, then charges when the product is already inside their heartbeat. The product is not the business model. The renewal is. Consider the silent influence of time. A company with a long implementation cycle can look doomed because cash recovery is slow. But if the switching costs harden and the product becomes a system of record, the lifetime value explodes. Another company can show fast trials and instant activation, yet carry a fragile base that churns when budgets tighten. One feels exciting. The other is enduring. The endurance comes from switching friction that is earned rather than forced. Integrations that save time, data models that become history, workflows that multiple teams share, and habits that make alternatives feel primitive. This is how stickiness graduates into inevitability. Now name the metric that closes the loop we opened earlier. When you measure how much your existing customers pay this period compared with last period, including those who left and those who expanded, you capture the net effect of habit, value, and pricing in a single number. When this number sits well above 1, the base powers growth even in a slow market. When it sits below 1, acquisition becomes a treadmill that never stops. You can feel the entire business in that single ratio. It is not a vanity figure. It is the scoreboard of product truth. Shift again and look at cash. Upfront annual commitments pull cash forward while revenue recognition stretches it out over the contract. This gap lets a strong renewal engine fund growth before accounting shows the profit. Without the renewal engine, upfront cash only delays the reckoning. With it, the company can invest ahead of the curve, shorten payback, and still remain capital efficient. That is why some companies can raise less money and still outpace better-funded rivals. Compounding from the base becomes cheaper than chasing the world. Now inspect cohorts, not quarters. Each sign-up month is a little bond that pays coupons. Bad cohorts amortize your hopes. Good cohorts refinance your future. When you see newer cohorts flatten higher and expand faster than older ones, you are watching product-market fit mature in real time. This is the reliable sign that you are not buying short-term noise. You are buying a habit that strengthens as the product's ecosystem deepens. Here is a contrarian line to carry forward. The best growth is often invisible at the start because it hides in a base you already own. That is why early companies with modest acquisition can still set the stage for dominance. They obsess over activation, time to value, the first must-keep feature, and the moment a team cannot imagine going back. They measure not just the signups, but the second week, the second month, and the second product attached to the account. That second product is not a cross-sell trick. It is a signal that the relationship is graduating from tool to platform. Make one more mental model and the fog clears. Imagine your business as 3 lifts stacked on each other. The first lift is new revenue. The second lift is the portion of last period's base that remains. The third lift is how much that base expanded. If the third lift is small, you must keep pushing the first forever. If the third lift is large, the first becomes optional, and the base turns into a flywheel. This is why founders chase ease of adoption early, but fight for deep integration later. Adoption opens the door. Integration throws away the key. The hidden engine behind every enduring software business is not a clever feature or a perfect pitch. It is the compounding created when usage begets renewal, renewal begets expansion, and expansion buys the company the time and cash to perfect the next layer of value. Name the numbers with rigor if you want to invest well. Favor businesses with short payback on fully loaded acquisition, retention that barely bends after the first months, expansion that lifts the base meaningfully every quarter, and pricing that maps to the customer's heartbeat. When those pieces fall into place, headlines become footnotes. When you watch the next software story, begin with cohorts and the base. Ask how long customers stay, whether they pay more over time, and how quickly the company earns back the cost to win them. If those answers are strong, growth is not a promise. It is math. If those answers are weak, growth is marketing. The difference is destiny. If this kind of cinematic breakdown sharpened how you read software businesses, tap, like, and subscribe for more deep dives. Tell me in the comments which company or metric you want dissected next. And tap the next breakdown on your screen and keep the momentum going.